Hello, welcome to another video from StageAnalysis.net. Today's video is my regular update of the major US stock market indexes and the key market breadth indicators, including the Bullish percent index, the percentage of stocks above their short, medium and long-term moving averages, the advanced decline line indicators, the new high, new lows indicators, and some custom indicators exclusive to StageAnalysis.net, including the sector breadth chart with relative performance rankings of the major sectors. The purpose of the regular market breadth update is to help determine where stocks will go next based on the combined signals of all the market breadth indicators, which is referred to in the stage analysis method as the weight of evidence. To see more of the market breadth charts and regular stocks watch lists, go to stageanalysis.net. And to get on my latest videos, please subscribe to the YouTube channel and hit the like button below the video on the YouTube page and leave any comments below. Quick disclaimer, all stock charts and ideas presented for educational purposes only, so always do your own research before making any trades. Okay, let's get going. So, this week, as always, we start with the major index charts, starting with the S&P 500 here. This week was an interesting week with obviously a battleground with the 3,000 level and the 200-day moving average. Stocks managed to get above it after quite a battle during the week. It was gapped above on the open a few days, and stocks tried to push back below, and eventually it traded higher and later into the week, and there was some rotation with some of the tech heavy sectors getting hit really hard, as obviously the Nasdaq shows. We had a strong thrust down, but they recovered near the end of the week with a push back towards the high with this weekly hammer type candle here. Obviously caused a lot of technical damage in a lot of the leading stocks, with some dropping as much as 20% in just a few days early in the week, which obviously some are arguing was a shakeout move. And obviously by the look of the weekly candle at the end of the week, it's quite possible that it was, but obviously they've now got to follow through and recover what they lost, and not all of them have. So obviously that's going to need confirmation this week with a follow-on move with stocks that got hit hard, making moves back above last week's highs at least, and ideally on stronger volume, because obviously they got hit very, very hard in a very short amount of time. So whether it was a shakeout or not is to be seen. But yes, as you can see in the Nasdaq, it did close back near the highs again, and is pushing back up towards the obviously early year high here. Obviously an extreme V-shaped recovery currently, and above a rising 30-week moving average. So the Nasdaq currently remains in a very strong position in stage one, but we obviously would expect some back and filling to come at some point sooner or later. So it's not going to go in a straight line forever. So don't get too complacent, because markets don't go one way forever. They tend to back and fill a bit. So we'll get some of that sooner or later. Whether back to the S&P 500, it's obviously it cleared the resistance level and the 30-week moving average and the 200-day moving average, but it's not far past it. It's literally hugging the line. So there's still fighting resistance here. So that one is not clear like the Nasdaq is. The Nasdaq is clearly moved into stage one after a very deep but short stage 4 decline, but the S&P 500 hasn't made that recovery yet. It's potentially shown signs of moving into stage 1, but it hasn't actually physically got there yet. But we'll see in the sector breadth charts a little bit later. There are signs in certain sectors of that rotation occurring. Talking of rotation, this week in the NYSE we had a very strong move with it pushing out and obviously back towards former resistance. However, the rotation only lasted as long as the weakness in the leading stocks lasted, and obviously got dumped on very hard the final few days of the week with a lot of the breakouts failing. So although the index here shows that obviously some were successful, there was a lot of stocks that a lot of turds floating to the surface basically that then got pushed back down again. So as you can see in the small caps, it's a bit more clear. So down here we obviously have got the opposite to what we've got in the Nasdaq, with obviously the bar closing very low with a high wick there. So yeah, not looking ideal for the small caps there. It looks like it was a failed breakout attempt, but we will see what comes. Okay, next we've got the Treasuries chart on the left here. This is the 7 to 10 year Treasuries. It's now been tight for 6 weeks in a row now, very, very tight, and still trading very close to the highs. Obviously this is reaching a crescendo now that it's going to break one way or another. So obviously with the kind of pattern it is with this flag, the expectation is for a break higher. With the volume declining, it shows there's been very, very little selling pressure there. So yeah, the path of least resistance remains higher for Treasuries, it seems, but we will see what way it goes. Gold, the individual gold stocks took a bit of a beating this week. Number of stop outs again, similar shakeout in as we saw in the tech stocks, but and we got some rotation with some silver stocks moving back into strong positions again. But physical gold itself recovered from the shakeout and closed back near its highs again, but individual stocks weren't so lucky. So yeah, gold is basically very close to its closing high, but it hasn't yet made it back to the breakout level yet. But volume remained quite quiet, so again it remains in stage 2, so the expectation remains for a continuation breakout attempt higher until we get something that tells us any different. Oil, the recovery bounce has continued. Obviously an extreme recovery it's had now. It's looking to fill the gap here, close the week near the high, so but it remains in stage 4, in obviously a stage 4 bounce below a declining 30-week moving average, but obviously it's been a very strong recovery. Copper had a slightly better week. It closed up, it's still below the breakdown level low and still below declining 30-week moving average, so remains in stage 4 for now. Next up, this is the percentage of stocks above the 150-day moving average done by sector. This is something I do myself each week by calculating obviously all the percentage of stocks above their 150-day moving averages in each of the sectors using stock charts, sector charts and data. So healthcare remains in the top spot and is the only sector to move back to a stage 2 level. As 60% is the level I watch for. Once stocks get above 60%, it's the sectors are considered at the stage 2 range. 40 to 60% is stage 1 or stage 3. So you can see technology is nearing the top of the stage 1 or stage 3 range, depending on that. But the majority of the other sectors still in the below the 40% level, and obviously energy and real estate still barely getting out of the lower teens. So this week, the strongest sectors were utilities and consumer staples, which is quite telling. It's quite defensive, but we did get some strength returning in tech, considering obviously the hits that the leading tech sector took. That was quite a strong recovery bounce there. So the overall average for the sectors has moved back to 35.59, which is the highest reading we've had for a long time now. Definitely, obviously since the March low, especially. Obviously, we've now moved above the key 30% level that we watched. So although we're still in the stage 4 level overall, we are moving out of the lower zone. So obviously that is a good sign of recovery. This is the visual chart of the same data, which shows the individual sectors placed on the chart based on where they are. As we said, healthcare here is above the 60% range, and technology and basic materials are above 50%, but every other sector remains in the lower half of the chart, below 50%, with 4 sectors still below the key 30% level here, and the NYSE chart index itself still below 30%, and the Nasdaq has moved into the 40% range, which obviously is because healthcare and technology make up a large part of the Nasdaq, and they are obviously our 2 strongest sectors. So This is the NYSE Bullish Percent Index and the Nasdaq Composite Bullish Percent Index, and below we've got the percentage of stocks above that 200-day, 150-day and 50-day moving averages for the NYSE and the Nasdaq. So I like to look at these all together as they give a great representation of where we are and what stage the market's in, and like are great for market timing in general. So as I've said before in my previous videos, all three of these are used together in order to get signals, not just the short-term chart that I see a lot of people use. The 50-day MA one is great for short-term signals, but we're looking for stronger signals, like medium-term signals. So you need all three charts to be giving you the same signal. So at the moment, the signals come from the point and figure charts, not the line charts. So because it's not always clear on the line charts, so we go to the point and figure charts to get the actual signals. But on the bullish percent, the NYSE bullish percent obviously had a very strong week and recovered back near the highs, but on the point and figure chart, this remains in a bear correction as it's not yet made a new double top breakout. And the Nasdaq Composite Bullish Percent Index, not quite a strong week. It had a good bounce, but again it's still below. But this one never broke down to bear confirmed, so it's actually, this one is on a bull correction. So a little project I've been doing this week is to actually combine the data from all of the 6 charts below into a single chart, and I've made that into a combined percentage of stocks chart, which I'll show you next. So this is the combined chart of these 6 charts. So the NYSE 200, 150 and 50 day, and the Nasdaq 200, 150 and 50 day, all combined into a single chart, so that we can get a much better picture of what's going on. So you're not just looking at a single short-term chart for your guidance or a single long-term chart for your guidance. And if we look at the historical chart of this, I think it gives a very good idea of the kind of values that we need to be looking for, of which is similar to what I explain in the sector breadth chart, where we have obviously below 40% is the bearish range and above 60% is a bullish range, and between 60 and 40% in the middle is a neutral range. So I consider above 60% to be when the market is in stage 2 and below 40% when it's in stage 4. So anything in between is neutral to that, which is obviously stage 1, stage 3 type price action. So as you can see, if we look back through time, you go all the way back to 2003 here. In 2002 we obviously had a similar extreme level where it got down to the very lows and made a move out. So obviously the level we're at currently in the low 50% range here is similar to obviously this kind of period here, and in 2009 this sort of period here. So we're not quite yet into the bullish range because we're still below the 60% level. But as you can see, in those sort of periods, there is also a chance that it could, although it's been strongly recovering and has powered from the lows all the way up into the low 50% range, like these moves weren't always successful. And as you can see, in 2002 we got to reasonably similar level. In 2008 we got to a reasonably similar level. In 2011 we got to a reasonably similar level, and we didn't quite get down to the lows that's extreme here, but we did obviously get back to the 50% level here. But each one of these in 2002, 2008, 2011 and what we got 2015 here, they all obviously topped out around this area and then had a pullback. So obviously whether they made new lows or not wasn't always the case. We know the 2002 one did, and we know the 2008 one went on to much lower lows. So if we continue powering on up through the 60% level and continue higher, as you can see in following that, once we get above the 60% level and actually manage to stay above it and get into a powerful range up here above 70% and a powerful range up here above 70% level, and the bulk of the action remains above that level, for that time. So that's when that was the start of a bull market, and that was the start of a bull market. So at the moment we're still in an area where it's historically turned down a couple of times in the past, but it's also managed to power through that area a couple of times in the past. So nothing's for certain, and we'll keep taking it day by day, as Chris Covey always says on his videos, which always makes me laugh, but it's very true. But obviously I try to keep it a bit more neutral, and so consider both the bull and the bear case, whereas obviously other people are very much focusing on only a single case. So, but yeah, in this case, obviously if we get back above the 60% level here and we manage to continue up into the upper range, we will very likely be in the start of a new bull market. But obviously if we turn back down where we are currently, then we could obviously go significantly lower still, or it could just be a more minor pullback like in 2011. Nothing's for certain. So yeah, just keep taking it a step at a time, and we'll see where we get to. Okay, next up we've got the NYSE advanced decline line. I did look at a different one this week. This is the one I always look at normally, but I did look at the common stock only, which is a lot more volatile, I noticed, and I did consider showing it to you because it hasn't actually made the breakout move as well. But I think this one, because this is what we use and this is what the data from all the other one, I think it would be unwise to change. I think this one's always served me very well, which is the total NYSE advanced decline line, which obviously includes all kinds of things that are listed on the NYSE, like preference shares and ETFs, etc. So not just common stock only. So, but this has made a small breakout here. This is the daily chart. The weekly chart, this is still below a key moving average, I believe, the 30-week moving average, but it's made a breakout here. We've got a cup and handle type pattern on it, which I don't know if that's significant on these kind of charts, but all we need to know is it's continuing to make higher highs in the short term, and the moving average is turning up. So the cumulative line is obviously in a bullish position currently. The McClellan oscillator over here also recovered the weakness we saw the other week, which obviously resolved in a lot of the leading stocks getting blown out this week. So, but obviously some have recovered, others haven't, like we said earlier in the video. But this did move back up again, and like the summation index, similar, obviously moved back up again, back into bullish range. Same with the short-term momentum index, it recovered its flush out here, and then it's moved back towards the highs again. So these three all remaining on bullish signals. The momentum index has broke out of the lower range, so it's a slightly bullish signal there, but still hasn't broken trendline resistance. I think it did early in the week, but it turned back down again. And the cumulative 10 and 30 day EMAs still remains on the bullish signal that it's been on since April time. So this, because it's not crossed over, it's continued higher. So yeah, the advanced decline line remains majority on a bullish signal. New high, new lows is next. So as always, we've got our 5-day total chart here of the US, which is the NYSE and the Nasdaq. Still fairly flat, not a lot happened. We're getting very, very low amount of new highs and new lows each day. As you can see, if you go down to the individual charts down here, 27 on Friday and on the NYSE, and only 81 on the Nasdaq there, but very few new lows either. So although we've got the moving average crossover on the cumulative line down here, but obviously the rebound remains exceptionally weak compared to the decline. So yeah, not a lot new to tell you there on that. This remains very neutral. Okay, right, I wanted to return to this one. This was the long-term chart of the S&P 500 compared to the unemployment rate data. Something we covered about a month ago in April, and wanted to see how that had progressed and whether we've got any new information. So as we said previously, in obviously 3 of the 4 cases, it was once the unemployment rate started trending higher, it basically the price didn't get back above the 10-month moving average and turn back below again. Only 1990 case here did it get above and continue on straight into a bull market. Obviously all resolved eventually in a bull market, but obviously there was a year or two in 3 of the cases where it trended lower afterwards. So where are we now? So we closed the month at 3044.31 and the 10-month MA is at 3003. So we had a slight close above the 10-month moving average. So we could be in a 1990 case here, but we still don't have enough information currently. It hasn't completely rejected the bearish case yet, as every period is going to be different, but there's a chance that obviously the worst cases might not happen, but we need obviously another month of data now to confirm if that's the case or not. But for now, it's obviously given us slightly better information than we had before, but not enough new information to tell us much more. Next we've got this is the chart that a few people posted to me during the week, and they were highlighting that when the disparity between the percentage of stocks above their 50-day moving average versus minus the percentage of stocks above their 200-day moving average in the NYSE, and saying how amazingly bullish this was, and telling me the market was going to rip, and all that kind of nonsense that you get from people that are obviously completely biased one way or another. So, but obviously wanted to look at this in a little bit more detail, as it is an interesting chart and we are in an extreme, and whenever you get to extremes, there's always some kind of move to look for. So I wanted to see what we actually got. So in the chart that was posted, they were proclaiming that obviously all of these spikes above it showed that obviously the market went into a bull market afterwards. This is 100% the case. Every single time, each one of these periods, the market has continued higher. However, there's a caveat to that. What they didn't show when they were showing these charts, and they were looking at these charts very zoomed out at very small levels, is that if you zoom in on the data, so we're going to zoom into 2002-3 period first, that when the chart reached that peak, so if we go back one, so we reached this peak, this is the peak, same data at the bottom here. So when we reach that peak where it basically gets above the 40-45% level here, we then had a good period of a pullback. It wasn't, and it's as soon as it started turning down, that began. So in this case, we had a 15-week pullback in 2002-2003, which was the final pullback before the bull market began. So yes, if you bought exactly here and waited 6 months, you would have made some money. But if you bought exactly here and didn't wait 6 months, you lost money. So that's not the greatest thing you want to be doing, as I know a lot of people that follow are quite short-term traders. You obviously want to get in at a time when the market is in your favour. So getting in at extremes when things are extremely overbought is generally not, on the short term, is generally not the greatest idea. So let's look for our next peak. So if we go back one, so our next peak here in 2009, both peaks in 2009 here. So if we zoom in on the 2009 chart, again, this peak immediately started to move down. We had 9 weeks of further decline where it dropped another 28%. And then this peak in April 2009 here, we had a slight pullback, only 3% there. So that one wasn't quite so bad. It was already rallying up, but that one was a secondary peak straight after this peak. So I'm not convinced that one's as relevant, but it exists, so that is worth considering. Same with, if we go back to the original chart again, so the 2011 peak here, as you can see, if we go back to that, so the peak in the 2011, we had a 5-week decline with another 10%. So But then obviously the market was off to the races again, and we had obviously a bit of a choppy 2012, but it continued higher and obviously began the very strong part of the bull market. So I just wanted to highlight that again, because obviously these peaks, although and the level we're at currently, like although it shows that the market went higher after every single time, it doesn't, if you look at it from such a zoomed out view and don't actually zoom in on the data and see what happened next, then you're doing yourself a disservice, because you could be getting in at a short-term high and obviously getting stopped out of your stocks and losing money unnecessarily. So always do the research and do your own research, and don't just rely on what other people are giving you. Like, look at that data yourself, like zoom in on like this area here and zoom in on this area here on the chart and compare. Don't just take what other people give you for granted, because they a lot of the time they're just pushing an agenda, and it's up to you to do your own research. So okay, on that note, back to the beginning. So thanks for watching. Basically, have a good week, and please like the video, and I'll see you on the next one. And yeah, visit stageanalysis.net if you want to learn more about Stan Weinstein's method. Okay, thanks a lot.